bank switching in the UK is super popular. Pretty much every one of those make some extra amount of money as a side hustle type websites, listed as one of the main sources of income. People say bank switching doesn't take long and it can work out as £100 for an hour's work if you do it right. So it's understandable to see why it's so popular. Switching a stocks and shares ISA is not like that. In this video, I'll explain why. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. Switching a stocks and shares ISA is not like switching your bank account. Here's why, and it's not just about time, it's about complexity, risk and hidden costs. First, in-specie transfers aren't simple. When you move a bank account, you're just transferring cash. There's no complication about what's being moved, it's just money. But with the stocks and shares ISA, you're moving investments and bring with it a whole new level of complexity. You've got two options: transfer your ISA as cash by selling everything, or transfer it in specie, meaning the investments themselves move over without them being sold. In specie might sound ideal because it means you don't have to sell and potentially disrupt your portfolio or deal with timing the market. But in reality, it's rarely that straightforward. Not all providers accept in-specie transfers, and even if they do, they might not support every investment you hold. Some funds or ETFs may not be available on the new platform, which means you'll be forced to sell them anyway. And even when everything is eligible, in-specie transfers are notoriously slow, often taking weeks or longer to complete. The end result is often a drawn-out process, with partial transfers, long waits, and a good deal of uncertainty. Then, being out of the market can hurt. If you go for a cash transfer, where your investments are sold and then the proceeds moved over to a new provider, you're going to be out of the market for a while. That could be a few days if things go smoothly, but more realistically it might be a few weeks. During that time, your money is just sitting as cash, not invested and not growing. If the market goes up while you're waiting for your ISA to land on the new platform, you've effectively missed out on those gains. On the flip side, if the market's full, you might be glad you're out, but it's essentially a gamble. Either way, the key issue is that you lose control over your exposure during that window. And because ISA rules are strict, you can't just reinvest the money somewhere else temporarily. Doing that could count as a new contribution and breach your annual allowance. So you're stuck waiting, watching the market move, and hoping the timing doesn't end up costing you. Also, exit fees and charges. Bank account switching is famous for giving you money, with providers offering cash incentives to lure you in. Stocks and shares ISA is often the opposite. In many cases, you'll actually have to pay to leave. Some platforms charge exit fees per investment, meaning if you hold 10 different funds or shares, you could be charged a separate fee for each one you transfer out. These fees often range from £15 to £25 per holding, and they can add up very quickly. On top of that, there may be account closure fees, transfer administration charges, or dealing costs, if you're forced to sell investments as part of the process. And none of this is always obvious up front. You often need to dig through the fine print to uncover the full cost. What initially might look like a financially smart move, switching to a platform with lower ongoing fees, can end up taking years to pay off once you factor in the cost of leaving your current one. Also, not all assets are transferable. Even if your provider supports in-specie transfers and your investment seems standard, not everything can be moved. Some assets, like fractional shares or funds that are exclusive to one platform, simply won't transfer. That's especially common with platform-specific offerings such as certain lifestyle funds or niche ETFs that may only be available through select brokers. In those cases, you'll be forced to sell and find alternatives on the new platform. And this introduces a different kind of complication. You'll need to reconstruct your portfolio from scratch. That means researching replacements, rebalancing your asset allocation, and possibly adjusting your entire investment approach depending on what the new provider supports. For investors with a long-standing, carefully curated portfolio, this can be frustrating and time-consuming. Not to mention potentially disruptive to your long-term plan. Transfer delays and errors are also common. When you switch a current account, there's a national system in place to make it seamless, the current account switch service. It's automated, regulated, and guarantees that payments won't go missing. Stocks and shares ISA transfers have nothing like this. Every platform has its own process, some digital, some paper-based, and there's no central framework to ensure consistency. As a result, delays are frequent. Transfers can take 4 to 8 weeks or more. Some providers still rely on printed and signed paper forms, and mistakes are not uncommon. You might experience missing documents, unclear timelines, or frustrating back and forth between the old and new platform, each one pointing fingers at the other when something goes wrong. For something as important as your long-term investments, being stuck in this kind of limbo can be incredibly stressful, especially if the transfer happens to coincide with the key market events or tax year deadlines. And then you have to remember it's mentally and logistically draining. Finally, there's a psychological and logistical load of switching an ISA. This isn't just a matter of filling out a form and waiting, you need to compare fee structures, which are often full of small, hard-to-spot differences. You need to make sure the new platform supports your investment strategy. You need to prepare for things to go wrong, to check and chase transfers, monitor for missing funds, and follow up when something doesn't arrive on time. And if you're forced to sell investments, you'll need to make decisions about when and how to reinvest, possibly in unfamiliar assets. It can quickly feel like a part-time job. For people who already feel unsure about investing, the idea of navigating this maze can be more than just inconvenient, it can be a major deterrent. So in conclusion, switching ISAs can be complicated and hard work, possible to mess up, which will cost you, might cause you to sell some of your investments or pay extra to move them over, which will cost you, possible to get charged for even trying to move an ISA, which will cost you. But let's say you still want to do it, let's see what's on offer. We can take 2 examples of ISA switching offers that have been sent to me personally to try and entice me to change my ISA over. First, Hargreaves Lansdown. It has a headline offer of £3,000 for switching your ISA, and that sounds good, and I definitely wouldn't turn my nose up at £3,000, but let's take a closer look at the details. Those who pay in or transfer the minimum £10,000 will qualify for £100 in cashback. But customers need to pay in more than £100,000 and up to £249,999 to receive the next level payment of up to £250. Then those adding up to £499,000 and beyond £250,000 will receive £500, while those paying over £500,000 but under £1 million will receive £1,000. Paying more than £1 million into an ISA or SIP and you'll receive the headline £3,000 in cashback. The deal does include those transferring drawdown pensions from other providers, as well as customers transferring into existing stocks and shares, ISAs and SIPs. So in order to receive cashback on your transfer, you need to transfer a huge £1 million to Hargreaves Lansdown for the top rate offer, and anything under £100,000 gets a measly £100. I mean, it's not nothing, but that's a big chunk of money to be moving around for £100. I don't know about you, but I certainly don't have £1 million, and even if I did, I probably wouldn't want to be moving around for £3,000. But not only that, you have to wait a year to get it. In order to receive cash back on your transfer, the firm says that you must keep your money in the account until 31st of March 2026. It said cashback payments will be made by 30th of April. Now let's take a look at another one that was sent to me to get me to switch over, Invest Engine. This one is an even higher offer at £4,000. But the threshold is even higher too, at an extraordinary £3 million. For those not familiar with the ISA structure, there's a deposit limit of £20,000 a year, meaning that having £1 million in an ISA is an impressive feat, let alone £3 million. Notably, the top 25 ISA accounts collectively hold £222 million, averaging about £8.9 million each. This suggests that ISAs valued above £3 million are relatively rare. Given the distribution of ISA values, it's plausible that only a small fraction of the 4,850 ISA millionaires have accounts exceeding £3 million. Considering these factors, it's reasonable to estimate that fewer than 100 individuals in the UK possess ISAs valued at £3 million or more. So the top end of this advert is probably only aimed at under 100 people. Then, as you go further down the thresholds, it becomes increasingly less worth it to transfer over. Unless you were going to do it anyway. And that's the point I'm trying to get at here. These should only be seen as merely a bonus for an activity that you are going to do anyway, not as the main reason for switching. Don't let the tail wag the dog here. Now, there'll be a lot of encouragement to switch your ISA at this time of year, the new financial year, as it's a very lucrative time for locking in new clients, hence the sheer number of adverts about it you've probably been getting from all over, brands, influencers, etc. The downside of listening to any of these is that there's a vested interest from these sources to get you to switch, as there's often a commission agreement to get new customers to sign up to these apps. For example, let's take 2 videos I've made recently covering the ISA of Invest Engine and of II, Interactive Investors. For Invest Engine, there's a commission agreement in place, so if you follow my link and sign up for a new account, you get a bonus and I get some compensation, essentially for telling you about it. For II, there's no such commission agreement, so if you sign up or not, I don't get anything either way. Now, obviously, I want you to use the one that suits you best, but it's human nature that I'd be happier if you went with Invest Engine out of the 2. I can't deny that. Even the influencers that go to great pains to tell you that they never take money for sponsored videos will still have a similar referral link and have a preference as to which you choose, often ranking them at number 1 of best ISA comparisons. Now, I'm not saying it's bad. As long as the information is not misleading, then it's a win-win for everyone involved, especially as the referrals often come with free sign-up bonuses. But it is hard to deny that there's an element of bias involved. So how to avoid this kind of bias when it comes to letting people know about different ISAs that might suit people better than the one they currently have? I think I came up with something. Let me explain. I set up a spreadsheet for the Dividend Temple Discord users to view a whole range of different ISAs to see which one suits them. Now, this isn't groundbreaking, there are many versions of this kind of thing. But what I think is a unique aspect of this is the last column on each row. This is where everyone can give their own perspective on an investment platform, then it's synthesized into a general comment. If you think that Hargreaves Lansdown is a rip-off for its FX fees, then add your thoughts in the input and everyone will have the opportunity to know. If you think that Interactive Brokers is great for more experienced investors, but you think that it might be a bit difficult for newbies, then give your thoughts. Once there are enough responses, we can have a good feel for what the community as a whole feels about certain brokers, as well as see if one can suit your own strategy better. And ultimately, I think that's better than you listening to me, as I have a certain strategy and that might not fit you.
If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!